Everyone wants to find that one stock, the one that's going to take a couple $1,000 and turn it into millions. And honestly, we get it completely. We don't blame you for being drawn in by that possibility because we're seeing it all the time now. You've probably seen that recent run from a company like Nvidia or Palantir and think, does it make sense to be hunting for the next stock that could make you a millionaire? Now listen, there is no shortage of headlines telling you which $3 stock is going to explode next. They show you past examples or draw you in like $1,000 in Tesla at IPO, be worth millions today. Nvidia, $10,000 15 years ago would be worth $18 million today. Here's the thing, they're not lying. Those returns did happen, but it's also a problem called selection bias. They don't show you the hundreds, actually thousands of other stocks throughout history that promised the same thing and went to zero. That's called selection bias. I want to repeat something very important. We understand exactly where you're coming from when you want these next big hits. We know why people get enticed by these headlines, but we want to make sure you know that there's a lot of BS out there and help you learn how to separate hope from reality, price from value. So today, we're going to look at one stock that's been hyped up right now, and that some people are comparing to Microsoft and Amazon back in the early 2000s. We'll look at what's being said, what's actually going on with the business, and whether or not the opportunity is as great as people claim. So guys, let's start with the headlines. This article talks about 6 stocks that turn just $1,000 into millions. Tesla, Amazon, Nvidia, Microsoft, Apple, Netflix. Here's the crazy part. Not only did all these companies turn you into a millionaire, your investment would have grown to between $2.4 and $15.7 million. What you need to remember though, is that those were the winners, cherry-picked from over 4 decades of market history. There's only 6 names mentioned here because for every Apple, there's a Pets.com, there's a Napster, which wasn't even public, but there's an MVP.com, there's all these, MarketWatch. The very website that I go to, apart from Everything Money, was publicly traded, went up 600% the day it IPO'd. Where has it been since? Now, just to show you guys how common these headlines are, here's another recent article from Motley Fool titled, "This $3 stock could be your ticket to millionaire status, hyping up the potential of Hive Digital, a crypto miner pivoting into AI." Guys, this is what these sites do. They predict everything, and then they take credit for the ones that do well, and they conveniently forget the ones that don't. And finally, the one we're going to dig into, an article from Motley Fool asking, could Opendoor be a millionaire maker stock? People are comparing it to early Amazon and calling for $82 a share, even $500 per share. Now, let's take a look at Opendoor. Their ticker symbol is OPEN, open, and see if anything actually holds up. Are the fundamentals built that it can show us the potential of getting to where everybody thinks it's going to go? Now, you see Opendoor at $5 a share, $5.85, and you think $500 a share, that's 100 times my money almost. Guys, they went public with a lot of promise, a company that can make a big impact on real estate by using new technology to simplify buying and selling homes. But here's what's happened since then. When the housing market slowed down and we saw interest rates rise, the stock tanked. And then by mid-2025, it was trading for just 51 cents as investors saw revenue fall year over year. Since then, though, it has bounced back. It's up over 13x from the bottom, and that's why the hype has really kicked in. I want to be clear. When the stock was down over 90%, there were 0 headlines claiming this is the next big thing. But now that it's risen, we can see clearly that news follows the stock price. So let's get into it. Guys, in the last 6 months, it's up almost 1,000%. So it's a $4.5 billion company. It generated $887 million in free cash flow. I'm not going to lie to you guys. I'm going to say wow to that. 5 times free cash flow. Okay. This is interesting. I was not expecting that. How do they have free cash flow suddenly? Let's look at their cash from operations, because I want to see free cash flows, cash from operations, less your capital expenditures. Interesting. So they just went from negatives to positive. But here's what's interesting. They had $2.3 billion, a big negative here. Okay. Seems like there might be turning the corner here. Cash from operations is getting, but what was this aberration here? Why 2.35? Oh, changes in working capital. Same thing with here, $1 billion of it was changing in working capital. So here's what I'm gonna do. I'm gonna go to the income statement and I'm gonna see how is their operating income. Let's see how it's doing. This is, operating income is basically the income before interest, taxes, all these other things. Operating income, negative 160, negative 250, negative 180, negative 570, negative 850, negative 370, negative 300, negative 200. It is getting better. Their revenue, getting a lot. Oh, interesting. Look at this revenue. 1.8, 4.7, 2.6, 8, 15.6, 7, 5.1, 4.7. It's actually declining now. So do you see how confused I am? You should be confused as well. We're looking at a company that everybody says, oh, it's up 13 times and it could go up 100 times. And they're in the process of declining revenue. Doesn't mean it'll happen. Let's break this down by quarter and see how it's doing quarter over quarter. So the quarter ending September of 2025, they did $900 million. The same quarter in 2024, they did $1.4 billion. I don't know what to say here. I look at it going, okay, maybe there's other news out there, but even if there was news out there that would skyrocket this revenue, I'd say it'd be off one deal. And you want to put all your eggs in that one deal basket. Guys, if this feels overwhelming, trust me when I say this, it's been overwhelming for everybody in the history of the world at some point, even Warren Buffett. You got to start somewhere, and I assure you that if you watch our videos and listen to what we're saying, you will understand companies and investing a lot better. But I look at this going, I mean, the price to sales ratio is very low. For a company like in software, it's like 8 to 12 usually. This is at 1. This is selling for car price to sales ratio. But the question is, how do they make this into profit? Another thing I want to look at, smaller companies tend to dilute shareholders. It's actually not that bad here. Dilution of shareholders, I'm doing the quarterly basis. Let's go to the annual basis. Heavy dilution. They had 544 million shares, now 750 million. So they're diluting their shareholders. What does that mean? If a company has 10 shares and you own one of them, you own 10% of the business. But if they need to raise money, they might issue 5 more shares. So instead of having 10 shares, they have 15 shares. You still own 1. You now own 1 out of 15 shares of the company. You went from 10% ownership to 6.66%. It's not helping you in that regard. Now, guys, I've gone through a lot of stuff here, a lot of key metrics. That is the confusing part, but I want to remind you, there's an easier way. I created a cheat sheet for you. It's exactly why I teach on YouTube. I realize that real good investing can be taught to anybody of any education level. It doesn't take a genius to figure it out. In fact, it's usually a genius that F's it up. So if you want to have these key metrics sent to you in a very easy PDF explaining it to you what they are, how they're applicable to companies, click the link below. We will email it to you within a few minutes, and it'll help you. And in a few minutes, I'm also going to talk about the price I'd pay for the stock. Let's go see if there's any analyst estimates on it. There are, and look at the analysts. They think they're going to be losing less money. More power to them. Revenue-wise, so guys, I'm looking at this right now and I'm already thinking to myself, okay, our stock analyzer tool, the purpose of this is you take today, you look at the company and say, what does the future look like? I think you guys can see from the inconsistent revenue and profit, I don't know what the future is going to look like. So really, anytime you're putting in some sort of guess in this company, it's exactly that. It's a guess. And if you do this enough times, you'll eventually be right. The question is, will it overtake and pay you for all the times you were wrong? That's what we talk about. By the way, the other thing I want to remind people is Microsoft's been a great investment for a lot of people, but they probably got in much later than they should have. The story I always give is back in 2012, I was sitting with the CEO of a tech company, and I said, Microsoft looked attractive. He goes, Microsoft, they're dead. And I'm like, how are they dead? Their revenue goes up 8 to 9% a year. Their profit goes up 11 to 12%. No, that's not true. They're just a dead company. I'm sure you now, if I found that guy today, he would deny ever saying that. And I remember being like, you're an idiot. Because I even said, well, yeah, you would take Microsoft, though, if it was free and had $50 billion in the bank. He goes, no, I wouldn't do that. I'm like, wait a second. You would. He's like, no, I wouldn't take it. I'm like, no, you could literally shut it down and get $50 billion. He's like, yeah, I still wouldn't take it. You might be hearing that going, there's no way you heard that right. 1, I did. And 2, that's the point of emotion. The market looked at Microsoft selling for 9 times earnings and said, this company is dumb. They look at this company up 13x in the last 6 months and say, this is amazing. Yeah, it could be amazing, but based on what I've seen so far, it's probably going to be a hard road. But let's sit there and put some assumptions in for the next 10 years. Let's say they grow revenue at 10, 20, and 30% per year. And let's say their profit, we're going to follow their free cash flow. Let's say their free cash flow is 15, 25, and 35%. So guys, first off, I'm going to tell you, this assumes they're profitable at these levels starting today. That's what my assumptions will be based off of. And my assumptions will be based off of them never, ever issuing another share. So they were diluting before, assuming no dilution of shares. That's quite the statement to make right now. What's the PE for this company 10 years from now? Let's go 20, 25, and 30. Guys, I have not hit the analyze button yet. I'm going to do a 9% desired return. This is the market return. This is not any margin of safety. I'm willing to bet a lot of money. This company looks at a screaming buy at this price. And for one reason, the price to sales ratio of 0.94. That is so low for a software business. I am very confident this will be a really big green. And I want to talk about before you go out there and buy it, because I'm not telling anybody to buy it. I would never tell anybody to buy any company. Before you go doing any more research about it, I want to make sure I explain the flaws in this. Hit the analyze button. Guys, I have felt that panic in my gut as well. When stocks fall, fear takes over. You start thinking, do I sell before it gets worse? I've been there. I've made those emotional decisions and I paid heavily for them. But patience and planning are what separates principle-driven investors from degenerate gamblers. Once you understand value and how to determine it, your perspective completely transforms. Price drops become golden opportunities, not disasters. That's what we teach at Everything Money. How to think long-term and stay calm when other investors start losing their minds and they dig holes that kneecap their financial future. Get access to the tools and the knowledge that protect your portfolio and your future from those emotional decisions that will destroy wealth. Start your 7-day trial right now. As I said, 30 on the low side, 440 on the high side, 130 in the middle. If anybody doesn't believe that was done completely blind, it was. That's where I want to take you to. I saw the price to sales ratio and thought, that's interesting. If these guys are able to even, guys, look at this. Let's do 5, 10, and 15% revenue. Let's do 10, 20, and 30% margin. Let's do 15, 18, and 21 in terms of PE and price of free cash flow. It's still a buy. So I'm actually going to say to you, this probably deserves deeper dive. However, you have to only buy if you see a clear path to profitability and growth. And this still assumes no shares are being diluted and still assumes they get profitable day one, which has not happened. These are things to understand that's the caveat here. But this is why we invest. We sit there and look at these saying, is this worth the time? In my opinion, 41% is worth the time. But it doesn't mean I buy because of this, because there's a lot of question marks here that I do not trust at all. All right, guys, now that we have covered Opendoor, which was being pushed as the next big thing, I want to let you in on an important lesson. You don't need to buy a company at IPO to make life-changing returns. In fact, in most cases, you are much better off waiting. And let me say that again. You don't need to be there on day one to make a fortune in stocks. I'm sure many of you have probably heard of Peter Lynch, one of the greatest investors of all time. He ran Fidelity Magellan Fund and averaged over a 29% annualized return for more than a decade. He also wrote 2 excellent books, which I recommend everybody to read, One Up on Wall Street and Being the Street. Right now, I want to touch on 2 of Lynch's most important points he emphasizes to new investors repeatedly. 1, if you can't explain it in a simple way, why you own a stock, you should not own it. What he's saying here is that you don't need to invest in complex businesses to make high returns. He also discusses the amount of money he made in simple businesses like Dunkin' Donuts, Taco Bell, Hanes brands. These are brands that nearly everyone recognizes. What he does say, though, is you have to be able to understand what the business does, their financials, and pay the right price. I'm going to ask you a simple question. Does that sound familiar? Number 2, and this is the one I really want to focus on because it applies so well to this video. You have plenty of time. People shouldn't be in a rush to buy any stock. He gives an incredible example. Walmart. The company went public in October of 1970. You could have bought it 15 years later and still made over 100 times on your money. And that's not as abnormal as you think. There are tons of examples like that. And yes, we are cherry picking, but every major company in the S&P could probably be applied that way. The reality is most companies are fully priced or overpriced during IPO. These are the shares that are being sold to you. Their job is to go out there on a marketing visit, marketing train, and get as high a price as possible out of the offering. So be patient. Take your time to understand the company and invest when the price makes sense compared to value. For Opendoor, maybe in 3 or 5 years, they'll have a much more consistent cash flow model and a high return on capital. Maybe I'll be really interested in buying at that point. But for today, it doesn't fit my process. Why does that matter? Well, guys, if I buy everything based on hopes and dreams, it might work out a few times. But if I buy everything on the right process, it might not work out a few times. Which way would you like to do it? Now, I want to show you guys an example of a company that was bleeding money just a few years ago, but has now flipped the script. Uber. This one we really look into a little deeper because when it IPO'd in 2019, it was only $45 a share. It was one of the most hyped up offerings on the market ever. And at the time, Uber was burning through billions of dollars in cash every single quarter. They weren't profitable. They weren't generating free cash flow. And investors were paying a massive premium for a company that hadn't proven that it could make money quite yet. If you bought in at the IPO, you went nowhere for years. In fact, 4 years later, you would have still been down. Fast forward today, Uber has transitioned to a cash flow machine, pulling in over $8 billion in free cash flow year to date. Now, the business is stronger, it is much more predictable, and it's making money. And guess what? You could have easily waited until 2023 or 2024 and paid the exact same price as the IPO after the business proved it could make money. That's why we wait. You don't have to be early. You just have to be right. So now that Uber is producing real cash flow, it's growing fast and initiated a large buyback program, let's check if today's price makes sense. So guys, let me pull up the cash flow statement to show you. Here's the cash flow statement. And cash flow is cash from operations less your capital expenditures. This is the real lifeblood of the business. Look at this free cash flow line. And this is a line that we add to our financials. Nobody else does this. -4.5, -2.25, -2, -5, -3, -700 million, +400, +3.4, +7 billion, +8.7 billion dollars. Guys, it became cash flow positive. If you apply a 20 PE to that $8.66 billion in free cash flow, that is $175 billion roughly in market value. What's the market value right now? 186. I'm not telling you it's fair priced. We'll get to that in a minute when we use our stock analyzer tool to determine the right price to pay, because a multiple doesn't tell you much if you're not factoring in the future growth of the business. Let's go look at our 8 pillars. A lot of X's here. I would have guessed it was like 6 or 7 check marks. It's 5 X's. Remember, 8 pillars don't tell you to buy or sell. It tells you a story. And that story tells me that even though these revenue, profit, and net income numbers have gone up, they're still trailing on the other numbers. But look, 5-year free cash flow, 5-year earnings are bad. But look how much lower the 5-year free cash flow is to last year, 3.2 billion versus 8.6. And 5-year net income is 2.2. Last year's net income is 16.6. So these numbers don't even matter to me. Don't even matter to me. What's last year's return on capital? The 5-year average was -5.8. Last year was 4. Big turnaround. Not where we want it to be, but a big turnaround. Let's go to analyst estimates. Now, analysts, 365 per share growing to 591. So it's growth there, but not a huge growth number. And then revenue growing from 60 billion to 85 billion. Basically double-digit growth for the next 3 or 4 years. So now we have some numbers. We have some story. Let's put it in the stock analyzer tool to see what the right price would be for a company like this. I'm going to pull up the last time I did it. Guys, I did a 10-year analysis. I did 6, 9, and 14% revenue growth for the next 10 years. I did 18, 22, and 26% profit margin. Same for free cash flow. What's interesting is their profit margin last year was 33.5%. I'm going to focus on that free cash flow here. Next, what PE and what price of free cash flow would I put on the company 10 years from now? I put 18, 22, and 26, and finally my desired return of 9%. Remember, 9% is no margin of safety, just what's the company worth to the market? What's the intrinsic value? The stock's currently at 87. I hit the analyze button. Guys, I have a low price of 90, high price of 316, middle price of 160. That's what's interesting about Uber. So listen, guys, you're going to see lots of so-called investing gurus point to a stock like Opendoor, slap on a Tesla comparison, and say, don't miss out. I see it at every draft, too. Oh, this player is like a Michael Jordan. This player is like a Russell Westbrook. Shut the fuck up. Here's the thing. You don't build wealth by chasing what might be the next Tesla. You build wealth. You achieve your goal of being a multimillionaire by being disciplined, buying great companies and great prices, and letting time do the rest. Now, if you thought this breakdown was interesting, wait until you see what I did. I handpicked 7 stocks that I believe can actually beat the Mag 7 over the next 5 or 10 years. And I'll be honest with you, Even I was surprised by the results. You're going to want to see who made the list. So click the video on your screen right now and check it out. Thank you for your time.